This is cassette tape number 4, and we're continuing on right here. We're going right through volume number 1. I just want to make a few comments on it. The jokes and the short statements. It was really designed so you can actually try to get an idea across in one sentence. This book is really designed for someone who doesn't really understand accounting, can't really reconcile a bank statement. And the repeat in the book is there for a reason, because too many times there's new terms, new ideas, and a lot of people have called me up thanking me for the repeat because they said they have enough trouble understanding this and they need that repeat. And a lot of people ask me to keep that repeat in there. So if you're just a quick study and you say, I understand it right away. I've actually taken people that say they understand it and I start quizzing them just like they would be in court, and they fall apart real quick. So I put this in here for a reason. I try to say things different ways so that you can understand it. All right. The short stories, they're true. This is as life as I can get it, as true as I can get it. But the thing is, I'm trying to show you how to take on a CPA bank expert witness and just destroy him at his own game. Because part of this thing is you have to be able to counter them and go after them. Now take a look. When I talk about the chapter back here, it says, you be the judge. And I give a warning, and also I tell you, should you sue the bank? And I say no. Legally, I have to say no. Okay? Yeah, I cannot legally say this is how you're going to go start suing banks. They could put me in jail for that. So these other guys that are out there saying, I'm going to show you how to go sue a bank, they could go to jail for doing that. So you got to be real careful. If you go to a lawyer or an expert witness, that's a little bit different. So I'm just simply running for president, and this is my campaign issue, so they can't put me in jail for that. But if you take a look at you be the judge, what I'm asking some questions back here, and I go back to saying, according to your understanding of the agreement. See, they want us to have to go back and get the bookkeeping entries that they had banked long time ago that made the loan that's no longer in existence. We know we cannot get that information. They try to hide it, and they don't want it anymore. They try to get rid of it. So what we're going to have to do to correct that is very simple. We're going to have to come back and we have to say, well, according to your understanding of the agreement, if there's an agreement, you tell us what you think it is. And you think the bank was supposed to follow the Federal Reserve Bank policies and procedures. If they start answering those type of questions, they're going to have one huge problem. And you can always go back and get that call report. So there's reasons why I'm trying to get you to ask, questions in a certain way, in a certain manner. I don't go into all the details as to don't do this and do this. I've been through this enough times, and I know a lot of times people want to start deviating. They want to go the wrong direction of ways that I know don't work. So I'm trying to show you the right way of going about this, the best way to go about this, to argue this for your seminar, for your mock trial, to show people what we're saying is correct. All right, I'd like to continue on right now. Sometimes people ask me questions, and sometimes it's just personal preference and things that I've seen out there. And like one of the questions is, somebody called me up on the phone right now and they said, Tom, can people go into court pro se? Well, the legal answer to that would be yes. Tom's suggestion is no. I'm strongly suggesting you do not do that. I'm tired of the pro se, going into court without an attorney, because these judges, they like to make it appear that they're being real nice. And at the last minute, they try and slam dunk you right when you think you're going in for the final trial. I've seen it happen so many times right across the country. And I think if you do that, I wouldn't do it. And I'd be scared silly. I really would, because those courts do not really recognize you like they would an attorney. And I just talked to a guy not very long ago. He was telling me, oh boy, this judge is so nice, Tom. I got an honest judge, and he's helping me. And and everything else. And we're going to have a jury trial, and this guy really understood courtroom procedures and everything else. And he went into court, and it just like it was rehearsed between the bank's attorney and the judge. They just said a couple things, and the judge, dismissed his case, and that was the end of it. He was out of there, and he thought he was going to have a jury trial that day. He says, I hardly even knew what happened, and all of a sudden it was gone. There was no more trial. And he lost. He was trying to sue the bank. And yet I know if there was a bank attorney versus an attorney on our side right there, I don't think that would have happened. So yeah, you can go and try those things, but you have to understand that judge does not want to hear this. And I've heard of a number of stories where judges have tried to do things like try to get both sides to settle out of court because they don't want to hear this. And it's like playing Russian roulette as far as I'm concerned, going in there by yourself. And I know if it was me, if I really had to go into court, I would want an attorney there. And I know a lot of people talk about the negative things about attorneys and whatever, but I'm just giving you my thoughts as of right now. And I have the right to change my mind in the future. But I think going in by yourself without an attorney, statistically speaking, you're going to probably lose. And I'd just kind of like to leave it at that. All right, I'd like to go on right now. And I want to go through volume number 2 of the American Voters versus the Banking System. This is part of the course in training you how to become like the CPA expert witness. And let's see here. Okay, I start out with the trial, and this is just one of the many different ways that people have gone about it. This is one of my latest suggestions. We have changed this many, many different ways as to how I would go about in a mock trial suing a bank, like especially if you had a seminar. And so that's chapter 1. Chapter number 2 is one day a farmer gave me a call. It was like 6 o'clock in the morning. He was calling from the Midwest, and I was like 2 hours difference. And he says, Tom, I got some questions. And he heard about me, and I try to work with some people, try to give them some information, because it gives me an idea as to what people are asking, because, I know this stuff just because of my CPA expert witnessing training. And I really forget sometimes what people do not know. I was really surprised when my girlfriend did not know what a promissory note was. Other people did not know what a lien is. Some people says checkbook money, what's that? And so it was very, very surprising to me. But if you made me repair your car, I'm not sure what a wrench is, okay? Or if you made me be a beautician, I know what scissors are, but I don't know if I'd cut your hair the right way. So we all have different type of training. And sometimes I forget that I'm not talking to other CPAs because I'm used to talking to CPAs and training certified public accountants. So chapter number 2 is because this farmer, in fact, I have it right here in the book. He called me 6 o'clock in the morning. I wasn't reading that when I said that. I was just going from memory. Forgot I even put that in the book. Well, anyway, he calls me up and he says, Tom, I got some questions. And he says, it doesn't say the word loan, so how do I really know they gave me a loan? I says, well, so he faxed me his document, and I started reading it, and I told him to give me 5 minutes and then call me back. I always make people call me on their nickel, because otherwise I'd have a huge phone bill. I figure if you don't want to pay for the long distance, I don't care to talk to you. Okay, because I'm giving a lot of my time out for free, just trying to help people. And you'd be surprised of the free time that I've given up just trying to help people, because I really care. I really care about people. And this is one of the reasons I've done all this, is because I really care. And I know we're going to get this thing turned around, but it's not easy. So anyway, I went through this chapter right here. These are the type of things that, these words right here, what I pointed out, like the word borrower, lender, they charged interest. Interest is for the charge of the use of money. They talk about line of credit, a loan, operating expenses, a note. All that's evidence of a loan. And then on chapter 3, what we've done is so many times, the bankers come back and says, well, gee, what was the person you talked to 10 years ago when you went to get this loan? I don't remember. I can remember the building. I can remember the room and the individual. I mean, I could probably point the person out, but the name and when you applied for something, what they said, oh man, you didn't even write down the date and the time because we weren't expecting there to be a fraud back then. And so now they're trying to come back and say, well, they're trying to give us real difficult things to try and wiggle out of this mess that they are in on the other side. So because of that, because they're trying to make it difficult for us, and they said, well, who said that they were loaning other depositors money when you went to apply for this loan? So I thought, okay, this is the type of stuff that an expert witness would do. So one day a couple of years ago, when this thing got started, people came to me because they had a problem. They knew my background being an expert witness, and they didn't have any money to pay me. So a lot of this was just done out of my heart, out of just because I care about people. I see their misery, and I'm trying to get them out of the problem. And one of the guys down in Florida, he had a banking problem, so he had me put together about 40 questions to ask the bank. That's now that became part of the manual, and that's part of the kindergarten questions now we have in Volume 2. The kindergarten questions set number 1. And other people had a lot of questions. There was some group out on the West Coast. They were wanting to know more about banking, and they just kept on asking me a lot of questions. And finally, they asked me to write up a bunch of questions. And I was going on vacation to see my parents in Florida for Christmas. And I was going to be gone like 2 or 3 weeks, and they needed the information right now. So while I was on my vacation, I was down there writing out questions, and I was on a cassette tape, talking to the cassette tape, going through as many questions as I think I could give, and that ended up as about 200 questions in the back of volume number 1 or number 2. And they wrote them out, and they put them in English because I'm not that good at English. And so a lot of this book was developed because people had questions. They had concerns. And I just kind of forgot that people didn't, know certain things. So a couple of years ago, I asked one person had an office, and I just didn't have a lot of time. And I said, tell you what, I'll help you. But you call up every Federal Reserve bank there is, and I want you to ask for all of their publications. So they did exactly that, and they gave me a copy of all of them, and I started reading through it. And I was the one that came up with the Modern Money Mechanics, page number 6, second column, second paragraph. They exchanged the Bowers promissory note for credit in the Bowers. They exchanged the Bowers promissory note for credit in the Bowers transaction account. Assets and liabilities increase. And that became a very famous thing that a lot of people learned about, and they went out and talked about. And then I started reading this thing about, credits, the postponement of the payment of money. Then other people started quoting, this once you bring it out. And a lot of people were suing banks, and they were reading this, and they had no clue what they were looking at. They really didn't understand. So we came across a lot of those different things. We tried different things, and there was lawsuits placed and other things, and they did everything they can to wiggle. In fact, one of the guys even sued the Federal Reserve Bank, and they did not even name the IRS. And the IRS came back admitting that they were an agent of the Federal Reserve Bank and asked to get out of the lawsuit, and we didn't even name the IRS. This is how powerful some of this really was. And the judges are really there to try to do whatever they can to aid and abet the banks. And that's why I don't like going in pro se. I've seen too many people just get really hurt, going in pro se, and I don't recommend it. So if you do it on your own without my blessing. So anyway, then banks try to come back and say, well, who was it that said this or that 10 years ago? So I thought, okay, you're going to get cute with us, I'll get cute back with you. So I called up the Federal Reserve banks, and I started asking for all the literature I could get. And they must have sent me a stack about 1 or 2 feet high, and I had to read through all this, and it took me quite a while.
And I had to glean all this information, and most of that information is in either volume 1 or in volume 2, page number 3. And I give you the page numbers, I give you the volume, I tell you exactly, what's being said. So it's nothing, but you have to go through this and you have to understand it. I know sometimes that here on chapter 3 of volume number 2, and I'm going right through what the Federal Reserve Bank is saying. Now, why am I doing this? Is because they are refuting themselves. They'll say one thing here, and they'll say the exact opposite over here. So you can come back and say, I believed them. See, it's not just this person who was saying it was in writing. And then they come back in the court and they try to say, well, gee, the Federal Reserve Bank publications are hearsay evidence. But see, your expert witness can use them. They can use hearsay. So just check with their own rules and regulations and laws on that. So that's why I put this in here. So it's really pretty important. And when I go out and do seminars, I have the publications right in front of me, and I show them. A lot of people like to glance at them and read them and things like this, because it's really kind of important. Okay. Then on chapter 4 of volume number 2, I go into a bank attorney's response. If you go back and read this is a real one, right out of court, okay? Because some of the people I've been working with, this is one of the things we got back, and I just put it in word for word, as they gave it to me. And a lot of times you got to be careful, because a lot of times an attorney is going to quote a court case, and they're not quoting it accurately. In fact, they might even say it says the opposite of what it really does. You need to go and check it, because it might be out of date, it might, whatever, okay? It might have been overruled, it might be wrong, okay? So you got to be real careful. They just like to make you think that, I'm an attorney, I can put this down and say what I want, and you'll never figure it out. When you're working, if somebody deceived you into this in the first place, and they're going to go hire someone to defend them, do you think they're going to stop the deception just because they're walking into court? If you think they're going to stop that deception, you got another think coming. Because a deceiver is an artist at deceiving. Then on chapter 5, we have a judge's response. And you need to read this, because they will take something you say and they will misconstrue it, and they'll try and turn it around. So I put this in here because you can obviously see that whoever sued the bank was saying the wrong things, because they're talking about creating money. No, don't talk about creating money. Don't even talk about money. If you were to sue somebody, you talk about, they recorded this thing as a loan from me to them. I have an actual cash value of this, and they gave it back. Okay, they returned the loan, the value back. Don't talk about money, because if you talk about them creating money, they're going to say, so what? They can do that. And if you have an agreement with them, then that allows them to do it, they're going to say, so what? We can do it in the United States. That's what they're going to come back and try and say. So don't talk about things like gold, silver, or creating money, or bookkeeping entries, because they're going to use that, and they're going to come back and only talk about those things and not talk about the real issue. So stay away from those things that are weak arguments. Stay away from those things that don't have any real value as far as discussion. Stick with the main issue. Who loaned what to whom, having actual cash value. Was the money they gave you, was that a repayment of a loan? Was there agreement to loan them something? No. So they not only breached the agreement, but they turned the whole thing around and make it a fraudulent conversion. Then they made false statements, and then they come into court using false statements trying to collect. And that's the type of thing that you want to discuss. And that's why I really think you need an expert witness, and here we are on page number 6. See, an expert witness can come in and they can get away with a lot of stuff that you're not going to be able to get away with, and do a lot of things. But you need to train that person, because just like, years ago when I did expert witnessing, if you came to me with this particular thing, you'd have to approach me gently. And, not just come on like a roaring lion and say, every single bank loan's a fraud. I wouldn't want to approach this or been your expert witness 10 years ago if you did that to me. And I'm a fighter. You need to approach me like, say, you know what? Here's some bookkeeping entries. This is how, this is how a loan, this is how depositing money is, and this is how withdrawing money is. I don't know what the bookkeeping entries are for a bank. I haven't worked for a bank. And then you come down here and just simply say, this is what they actually did. They had me sign a promissory note, and this is what they did as far as bookkeeping entries. They recorded as a loan from me to them. They repaid it back to me, and they lied, and they said that they loaned me their money. And what they really did is they stole $100,000 from me. And I find out, I think they're doing this to a bunch of other people, and then they took the bank loan agreement and they altered it, and they did some stuff to it to change the whole agreement and make it mean the opposite. And I need you as a expert witness to know what the bookkeeping entries mean and to testify according to what the bookkeeping entries are. Could you do something like that? If you approached me like that, I probably would have said yes. How much are you going to pay me? And if you were going to pay me enough, I'd probably say yes. And then I get all interested in it. And then next week you feed me with a little bit more information. Next week a little bit more. But you got to get me to sign something off saying that I will do this if this is the case. That way I can't back out of it. But even years ago, you would have had to approach me gently. And if you handed me Tom Schaaf's book, America's Hope, and says, read this, and I'm going to be back tomorrow, and you tell me if you want to work with me or not. I says, hey, wait, this is a universal problem. I don't want to get involved. But if we're talking about this is just your transaction, this is what happened to you, and you got the evidence, and you'll present the evidence to the expert over time, the expert witness will probably say, okay, I'll take on the case. And this thing develops, and the guy's starting to get into it, he's starting to see it, and then he's getting angry, now he's all on our side. But this isn't something, you just say to an expert witness, and all of a sudden, 10 minutes later, he's all on your side, he's going to work with you. You got to do a sales job to that expert witness. And then we have a lot of questions as to why we're going to ask all these questions. The whole thing is you want to ask the questions in such a way they have to respond the way you want. If you look at a lot of the questions, I don't really care if they say yes or no or I don't know. It doesn't make any difference to me in a lot of cases, just as long as they get some type of response. If they don't know and they're a bank auditor, then they're not competent to have done the audit. If they're a bank controller, bank president, and they say they don't know, then they're lying because they have to know. That's their job. And then if they don't know, they can't argue back. They can't refute anything that you're saying. If they say yes or no, then we can get them in breach of the agreement. And we want to make it so obvious that any jury will say, hey, that's not the way it is. That'd be wrong. Why do you have to... You telling me you're going to sign a promissory note and the bank owns it without them loaning you a check to obtain it? What is this? Because that changes everything. So those are the type of questions. We want to ask them about policy, about bookkeeping entries, because if you ask about policy, that has to do with intent. Intent has to do with criminal, it has to do with knowledge. They knew what they were doing. And so if you talk about policy, you have to follow the Federal Reserve Bank policies and procedures. We have it all in written form. They're telling us what it is. And then if you talk about the bookkeeping entries, we have the accounting principles, which means a liability means they owe legal tender. A liability means you loaned them. You were the depositor. You were the creditor. So according to the bookkeeping entries, okay, according to your understanding, Mr. Banker, how is it supposed to be? We don't care what happened back then. You have an agreement. You tell me what you think this agreement is. See, they can't. Those are real tough questions for them to ask. And we want to embarrass them. We want to show the whole world that they knew what was going on. We want them to tell us what money looks like. because they can't tell us what credit looks like. That's a bookkeeping entry. There's no dimensions of that type of money. You can't see it. You can't take it home with you. And how can they loan you something they don't even know what it looks like, and you can't go home with it? See, they got a problem. So those are the type of reasons why we want to ask those type of questions. They can't tell us what happened first, the chicken or the egg. Note, check, note. So they can't, tell us. That's the type of things we want to ask them. We want to keep it basic, keep it simple. There's many, many questions in here that you will never need. But they're in the book. Why is that? Because I want the bankers to know that you are well equipped. You can thumb through this thing and you'll make a decision as to how you choose to verbally attack them on the witness stand. And you can change these questions around a little bit here or there, whatever. But once they understand that this information is out and they don't know who has the book, it is very, very scary for them because they know they could go to jail by lying on the witness stand. And they got to have an expert witness to refute your expert. And you're saying, come on, we want to see your expert. We want to put him into a deposition. And you want to go through each and every one of these questions. And if they're saying they don't understand, that means they don't have the competence. Okay? So keep the questions. A lot of these questions I have in here are compound, and you don't want to use compound questions. You break those compound questions down into small, tiny questions. Because if I had to break them down into small, tiny questions and put space in between all the questions, I have another 100 pages. And I'm trying to give you the general knowledge. The next thing is in this book is the accounting principles. Now, let's just talk about the accounting principles. This is really important because anytime you're talking with any accountant, they have to follow the accounting principles. So what you want to do is go to the community college that teaches accounting. Go to a four-year college and get the junior year of intermediate accounting. And they'll have those accounting principles, and I could also supply you with information so you have it firsthand. And the accounting principles of matching, what it requires is the revenues have to be matched with the expenses. As an example, I have books. If I have an income statement, let's say I sell $500 worth of books, I have to show the expense of purchasing, what I paid for those books matched with what I sold those books for. That's called matching. Also, let's say I got 500 books and I did not pay for them. I record those books as an asset on my accounting records with an offsetting liability saying I still owe money for those books. So it's like the printer loaned me the 500 books because I have a liability on my books, my records, saying that I haven't paid the money yet. So it's like the printer loaned me the 500 books until I paid him for those 500 books. So the matching is I have a new asset that's 500 books matched with a new liability, and since I got the books from the printer, I owe the printer the money. Now in banking, because the banker got the promissory note from you, they owe you the money. And what they did is they converted it and they said they don't owe you. And they wrote a check off that checking account and they gave the money to someone else. And that's the conversion part. So it's real important, the principle of matching. And we come over here, the accounting principle of representational faithfulness. So we have to look at the economic substance regardless of the legal form. So they can come back and say the legal form is we said we made a loan. We say, well, we don't care what you said. We're going to take a look at the bookkeeping entries, and we're going to see what those bookkeeping entries say happened. So the bookkeeping entries record a loan from the borrower to the bank, and then the loan from the bank back to the borrowers when they took the bank liability, in that transaction account, the borrower's transaction account, and they wrote a check out of it, and they transferred the liability from that account to another account. That's the loan from the bank back to you, or the repayment of the loan earlier, the unauthorized loan from you to the bank, however you want to, call it. Now, these CPAs, they have to know what these accounting principles are. So when they go to testify, or the controller of the bank, they have to know what these accounting principles are. And that simply proves our case. Now, the accounting principle of conservatism simply means, when in doubt, you don't overstate assets or income. Well, that means they can't claim they own the promissory note until they have paid for it. They did not pay for it. Transferring a liability out of your checking account to some other checking account does not mean the liability has been paid. It simply means it's been transferred. To pay that liability, they have to cancel your loan. They didn't cancel your loan, so they're not following number 3 accounting principle of conservatism. Take a look at number 4, objectivity principle. Now there's an accounting language, and we have to look at the objectivity and verifiable information. And what this really means is accountants have to be honest. And if, let's say we didn't know anything else. Let's say there's some accountants out there and they did not know anything about banking. And they saw a new promissory note as an asset offset by a new bank liability. And there was a quiz. Let's say they were trying to pass the CPA test. And the CPA test says there's a new asset, new liability. Tell us what the possibility is right here. So you'd have to write down, well, it'd be a loan from the borrower or whoever had the promissory note to the bank. The bank stole the promissory note. It was a gift to the bank. It was a fraudulent conversion. Okay? That's the only alternatives they can say. Now, if they showed a check written from a demand deposit account and given to another person, then they could say, well, gee, it looks like money was taken out of one checking account and deposited into another checking account. That's the only thing they could really say. So if you only looked at the bookkeeping entries and you didn't know what the agreement was, and you only looked at the bookkeeping entries, the CPA would have to conclude that the borrower loaned the bank the promissory note, and the bank never gave up 1 cent of actual cash value to obtain the promissory note. That's the accounting principle. They have no choice. They don't go around changing accounting principles for banks. Banks are no different than a manufacturing company, a restaurant, a hairdresser, or anybody else. So they got a real problem. So I put in the accounting principles right here because that's how important those accounting principles really are. And then I go into the audit requirements. And we're going to talk about this a little bit more, but since it's in the book, I give out 10 of the audit requirements. Now, this is only a minimum. They have to do other things. See, there's no maximum, but there's minimum things that they have to do in an audit. And an audit is simply an investigation. It's like a police detective to make sure that the income statement, balance sheet are materially correct. Now, when you look at accounting, they have to look at the bank loan agreement and make sure that the bookkeeping entries are in correlation to that agreement. Now, remember when people said there was a bank loan fraud before I ever got started? And I was out to prove to the world there is no bank loan fraud. I knew, according to the bank loan agreement, that they had to loan me other depositors' money according to the agreement, because they said they're going to loan me a check if I sign this agreement. Well, that means that the other depositors cannot spend their money, and I can. They have to actually take it out of their savings account or CD. That's not the case. We know that didn't happen. There was a trick going on. And I guess that's why the other auditor who exposed this to me told me it was a one big, massive fraud. And he knew about it, and he explained it to me, which I went into earlier. So I know, according to generally accepted accounting principles, they have to do certain things. They have to match the bookkeeping entries with the agreement of the loan and the generally accepted auditing standards. Now, the generally accepted accounting principles, that's GAAP, that's the standard bookkeeping entries, and all banks do it basically the same. There's a short version, a long version, it all comes out the same in the end. The generally accepted auditing standards, that's the investigation thing. That's where they go in and they start ripping apart the financial statements to make sure that they're okay. So you might want to read this particular chapter, and I go into some details in that. All right, then I go into, when I started thinking about this, it just got me plain mad. And every time I get mad, I sit down at the word processor and I start going at it. And that's how I came up with Chapter 10. I said, I'm getting sick and tired of what these people are doing. I want my people to have some really good questions. So I came up with these questions. I was only going to come up with a few, and I ended up with, over 100 questions. And when we have time, when we get done with this, I'm going to go over a lot of the requirements a CPA has to do. I'm going to go over the audit. I'm going to even show you how to audit a credit union, which is just like a bank. I have the audit thing right here, how to do it. I bought the book, okay? So it's going to be really a lot of fun. I'm going to show you the business law that CPAs have to know in order to take the CPA test. And these CPAs, they have to know a lot of this. And the banker, president, and board of directors, chairman of the board, they have to know this stuff too. They're responsible for all this, but they're the ones who created all this. All right. So you need to read all that. Don't just listen to the tapes. You need to go through it and read it. And once you start to understand this, it becomes pretty simple. It becomes second nature. And I gave a lot of references, if I remember right, in the questions as to where we're getting some of this information. Okay, because even out of the CPA manuals and things like that. All right, on Chapter 11, I talk about the title insurance. And again, I didn't put this in the book, but you have to make sure that when you paid that title insurance, who was the beneficiary? Was it you or the bank? That's going to tell you a lot as to how you want to proceed. Because if the bank is the beneficiary, that means they own the title, don't they? And then we go into common bank defenses, and one thing I didn't put in the book is a lot of times the bank will try to put like a bank teller on the witness stand. So you start asking this bank teller about the bank loan and all this, and they go, gee, I don't know. I just count the money. I just, at the bank teller, I got 5 kids, and I'm just trying to make some extra money, put bread on the table. I don't understand about the bank stuff. So their common defense is put somebody on the witness stand that doesn't know anything. So when you ask them all these sophisticated questions, the banker goes, I don't know, I have no idea, I don't know. And that's how they try to win these cases. They believe if they don't give you any paperwork, if they can't answer anything on the witness stand, they think they can win. That's why you need an expert witness. And then the signature, they're going to try to come back and see, it's just like they want you to sign papers saying that what they did is legitimate. It's just like a thief comes to you and says, I'm going to loan you $10,000. So you sign an agreement saying you're going to repay the $10,000. He steals your car. He sells your car. He returns the proceeds back to you and says he loans you the money. And then he comes back and says, but I got your signature right here. You got the money and I got your signature and you're going to repay this loan. And you're coming back and say, wait a minute. This signature that I have was agree that you were going to loan me your money, not steal my money and give it back to me as a loan. So this signature in my mind, only attest to the fact that you were supposed to loan me your money. You didn't do it. Since you didn't do it, I cannot attest that this signature is correct because I know you didn't do what this document stated. So I don't think this is a valid signature. Now, I wouldn't go into it like that in court, but that's how I interpret it. All right after the signature on trial, I talk about Mr. Crawford, and I may make that into a whole new chapter when I go to reprint the book. But you'd be surprised how many real court cases I have in here where it just looks like a real example. You'd be surprised how real this book really is. And how maybe I'm not supposed to tell you certain things, but it's maybe in the book. Hint, hint. Okay, let's go on to court rules. Why did I put court rules in here? I put court rules in here because I want you to know that a lawyer cannot do certain things. And what I think you ought to do is write to the opposing lawyer, give it to him, registered mail, return receipt, insured, be nice to the guy, don't threaten him, give him the proof that you're right using the Federal Reserve Bank's own publications. Then you can go into court, and I think you might even have a lawsuit now against the attorney because now he's bringing fraud into the court. Attorneys do not like to be sued. Okay? I understand one guy, he just, anytime a bank came up with an attorney, he just attached the attorney to the lawsuit and had to start the trial all over again. It was really funny. I don't think any attorney really wanted to represent that bank anymore. All right, I'm not telling you what to do. I'm just trying to tell you things in the past. And obviously, you find out this banking thing is one big pyramid. Now, when I put in court exhibits in this chapter, it's not really something that you would necessarily put into court. This is really to convince the American voters. This is real information. And I think it's really here to tell you a story, to give you good information so that you have a better idea about banking and how banking works. And that's the purpose behind this. I'm trying to show you that Congress might have gotten 1.7 million signatures and they just ignored it. See, they're not going to pay any attention to you until you're able to vote them out of office. The judges know that. They know, these judges know exactly what's going on. I believe they're told about this either by memo or by the judges' school, and they're told to keep quiet and not allow people to win. That's what I believe, and that's why I believed in order to embarrass them, I really believe you need a good expert witness and a good lawyer. That's what I really believe. Okay, so I'm trying to tell a story here about banking through these different exhibits. And then when you want to go to subpoena documents, I have different ideas for you down here. And I already talked about in the cassette tape why we need these documents. Because the attorney is going to come back to you and says, well, gee, why do we need this one? Because the judge is asking. I already went through that in other tapes. And please remember, this is a trade secret. This is confidential information. This is a copyrighted cassette tape. Tom Schaaf, 1997. And no one is to be listening to these cassette tapes unless you have signed an approved contract agreement with me and giving us the money. We're trying to raise money to get this whole banking thing turned around. And we're giving you enough books when you buy the course that you can just retail some of the books and get your money back. That helps get the information out so we can get more and more people woken up. And that's the whole idea, because I tell you, if you just stop and you don't get the information out and keep it going, we're not going to win this country back. So we're trying to help you, but help us win the country back, okay? That's what it's all about. So then I start going through this, and I'm starting to ask many, many different questions in different specialized fields, and I take the same thing and I regurgitate it, say it different ways. I have some court cases in here also, just talking about how things used to be in the past and how things obviously have changed now. I have some letters in here. Look, guys, when you write these letters, do not threaten the banker. Be real careful about that, because They're real sensitive. They have to look at the law. So I'm just trying to put down what I know other people, the type of letters that other people have written and the type of responses that people have given back. And what I'm trying to do is I'm trying to educate you through this letter to the bank. Okay? So this whole thing is trying to educate you. The responses back from the banks are real letters. These are type of ideas. Now, it's really kind of hard for the sheriff to come and steal your house working for the bank when you're telling him you're here to report a crime and you want the banker arrested. See, it really creates a problem. Then we go into the bear trap type questions. Now, the bear trap type questions are really designed just to kind of get started. It's not the whole thing. It's just to kind of give you an idea how to get the thing started with different people. And there's different ways to go about it. And there's enough questions in here once you get started. And see, like here, there's one question that says, how much money was the lender to loan to the borrower? See, what if they say $100,000? The next question is, what's money? Is it check? You know, you want to know, you're saying demand deposit account, is that money? Would it be money if you can't pay it in legal tender? So really the new asset and liability are matched. Just like in the accounting principle, if the liability is bank liability is money, then the asset behind it is just as valid as money also, because otherwise the liability can't be paid money. You couldn't get money for the check. So you ask these little tiny questions. So when you say money, you're trapping them into the fact, later on they're going to say, well, would that be legal tender? And they're going to say, yes. Does a bank record legal tender as a bank asset? The answer is yes. Now you just trapped them into they had to loan you an asset, and they're going to try and say, we can loan you a liability. And now they have to admit that they loaned no actual value to obtain the promissory note. So these things are just to kind of get you started, and then you can kind of go from there. And I'm going to tell you, they have wiggled about every which way not to answer any of this. Because, they know how deadly this stuff is. All right, I don't want to have to go and read the questions. We're going to go on to the next, we're going to go to the other side of this cassette tape, okay? Let's go to the other side. Hello, this is Tom Schaaf. This is cassette tape number 4, side number 2. And right now we're looking at volume number 2 that I have, and we're just kind of going through it very quickly. Really, when you get done, you find out there is no money being circulated in the United States. All it is promises to pay money. They're really notes, they're liabilities that people have created, they're IOUs. And because of that, if the banks could just go out and create all these deposit receipts and lend them to you, it's just like creating money, and you end up in a huge amount of debt, and they end up owning the whole country for free just because they have a right that you don't have. And this is one of the oldest bank tricks there is in the world. And I'm going to tell you a second time. I know I said this earlier. I'm going to say it again because it's that important. The history of the world shows that when people wake up as to the banking system, it gets turned around and we throw out the money changers. And then a couple generations later, people forget and the money changers come back and they do it to us all over again. And then when people get up in a huge amount of debt and they start losing everything, people wake up and they have to, educate everybody else. They end up, once enough of the population is educated, they throw out the money changers. So I really believe going into court prematurely without the population behind you is foolish. And I know a lot of people, they just want to be able to have the silver bullet, go sue a bank and take a vacation, come back and have $1 million. And it's foolish. Instead of suing the bank, I'd almost rather have you be in these clubs where we're using the clubs and the members in the clubs to buy these foreclosed properties and profit the members of the club through the foreclosures and also help the victim. And because we do this very long, you could have quite a bit of wealth. I don't get any percentage of it, but we're putting you into groups. And by having leaders in groups and things like this, what we're really doing is we're working together, because a lot of times you can go out and buy a foreclosure package and, hey, you know what? People spend $500 and they don't do a thing with it. What we want to do is you come in, you pay for a membership, you get some books, you sell 4 books, you get your money back, and now we start teaching about these foreclosures, we start teaching about banking, and all these different things like this. So our whole thing is, our whole program is, we want to teach you, but we want you to pay something, get some books, and then you could just go out and retail the books and you get your money back, but you still get the information. That helps us on a national level, so we can do the research, so we can go out and do the things we need to do to try to win this country back. We are not asking for contributions, but we're asking for honesty, and that's why we really appreciate it when you are not copying these cassette tapes and when you're not lending them out to other people. If they want the information, let them go ahead and pay for it, and then retail a few books and get their money back. It's just that simple. Then we give you a certificate, then we know who you are, so if there's changes, we can let you know about the changes, because otherwise people get the tapes, they only get part of the tapes, and they go out half-cocked, they make really tremendous mistakes, and they start making bad case law. And that hurts everybody when there's bad case law. And it's really sad. Now, another thing I want to bring up is a false swearing. Look that up on the law dictionary. See, they want you to come in with a false swearing under oath to affirm something that's wrong. That's a falsehood. So when they talk about your signature and they want you to affirm that the bank did this, your signature cannot affirm to that, because you know it's a lie. You know that it did not happen. The transaction did not happen. So therefore, it's not valid. And since they altered this document, it's not valid. And one of the beautiful things is this. If a bank purchased that promissory note and they cannot produce it, what evidence do they have that it was never altered? They were not there when it was allegedly signed. And the person who sold it to them could have altered it and could have stolen it, and they don't have any idea. So you're there trying to invoice the bank and say, look, this thing's been stolen, I'm invoicing you, I want this thing back. And they're saying, look, you keep on making payments, we're going to come and steal the rest of your equity in your house. So now you got them in receipt of stolen goods and property, because you told them, they knew, they continued, and they're trying to force you into making payments. And I believe that would be called extortion. Look under the larceny, rules. Also, take a look at false token under the law dictionary. It's talking about a criminal law, a false document, or so it's like a counterfeit. So take a look under those words right there. So what the bank is using is a false token to get you to make a false swearing to claim that it's your signature that you got the money. I mean, how evil can this thing be? So I want you to take a look at those, words right there. If it was me personally, I wouldn't spend my time going into court. This is how I want this thing to happen. This is how I want it to come down. We got to keep on getting the information out to the voters. We got to keep on getting this thing out, because as we keep on getting books out, more and more people are talking, and it's going to be harder and harder for them to continue doing this. If we can get enough CPAs to understand this, and what I'm showing you right here in this book, what's going to happen is, once enough CPAs know about this, these bank auditors are going to have to come to terms and redo the bank audit, and that makes it real easy for you to go and sue the bank at that point. So we want this thing to work, so that, because a lot of these CPAs are saying, hey, if I can make $100,000 a year working part-time, be an expert witness, I'll do it. So it's not that hard to get these CPAs to be an expert witness in your area. That's what my belief is, once you get enough information out. As that starts to happen, you're going to start getting the lawyers coming in on our side as well. Now, I want to turn the sharks against the sharks. And I want the lawyers to do this on a percentage thing, because I see them looking at these banks as big bucks. And as we keep on getting this information out to the voters and keep on getting these books out, and that's why when you purchase this course, you get enough books, you can retail it out and get money back. So it's like getting the cassette tapes for free or a nominal cost. So by getting the information out, you really get your information for free, and then we can work with you. Okay? So that's part of my thoughts. Now, I want to go on to something else right now, but I just want you to use your imagination. Just think about, keep on getting this information out to people. You know, you never know. You give it out to somebody, and they know somebody else, and they get it over their accountant. I had a CPA. It was a lady. Give me a call, and she says, "You know, I got little kids." She says, "I read your book," and she just flipped out. And she had to do some checking and found out what I was saying was correct. She says, "Tom, I'm on board. I want to do anything I can to help." She says, "I'll be a leader. I'll explain this to people." And she bought 50 books from me because she wants to get this thing out. She has a lot of clients, accounting clients. And so her idea is to get this information out to as many people as possible. And we're picking up expert witnesses. I think in the last month, I think I've heard about 3 or 4 expert witnesses we just picked up, something like that, maybe last month or two. We're getting more and more accountants coming over to our side. We're getting bank auditors. I just had a FDIC bank examiner buy the first book, and he wrote a letter back, and he liked it so much. He wanted the cassette tapes. He wanted volume number 2, and because he's getting into this, he didn't understand all this, okay, or how to explain it. I've had bank auditors come to me and says, "Tom, we know there's a fraud going on, but we don't know how to explain this. We're not expert witnesses. We don't know how to explain this to a jury." It's my job as an expert witness to make it simple enough that a jury can understand it. And that's where you have to have the gold coin, the silver dollar, the dollar bill, the IOU right in front of the jury as far as exhibits, and ask the question, is the bank deposit receipt the money, or is the gold coin the money? Which one's the money? And when they have to come back and say the gold coin's the money, then they cannot claim that the bank can create bank liabilities and that's the money. The bank liability is the money. They can't say that anymore. It destroys their argument. You win, they lose on that argument. And that's the argument you got to destroy them on if you're going to try and win the case. Okay. I want you to open up volume number 1. That's volume number 1, America's Hope. And I want you to go to the chapter where it says the bank bookkeeping entries prove the truth. Now, I already talked about the accounting principles. So now we're going to go over here to the bookkeeping entries. Open it up to example number 1. And as you look at example number 1, we're going to deposit $6,000 of cash into the bank. Now, if you look at it, an asset is something that you own, something you can sell, something you can look at. You can look at a house. You can sell a house. You can look at cash. You can use cash to go buy something. A car is an asset because you can look at it, you can see it, you can sell it. So you can own it. So an asset is the left-hand column. The liability is in the right-hand column. Sometimes people call the left-hand column the debit and the right-hand column the credit. It doesn't make any difference. Left-hand column is the asset, right-hand column is the liability. Look, there is no good guys or bad guys. It all is this is a way to keep score as to what you own and what you owe. That's all it amounts to. So they record the cash because they deposited cash into a checking account. The bank records the cash as a bank asset, or the asset column, which is also called the debit column, which is the left-hand column. And then they credit a demand deposit account. A credit is the right-hand column, which is the liability column. They put in $6,000 in the right-hand column. So what does this mean? It's the same thing as if you loaned the bank $6,000, and the liability column under demand deposit account says there's a $6,000 liability. A liability is a debt. is what the bank owes. They owe you, that's all it is a scorecard, is that they owe you $6,000 because you gave the bank $6,000. You loaned the bank $6,000 and you can get your money back whenever you want. That's all this really amounts to. It's real simple. All right, so you can go ahead and read this little example right here and see what it has to say. All right, I want you to read this little paragraph I have right here, but the one thing I want you to remember is when you deposit money at a bank, the assets and liabilities increase at the bank by the amount of the deposit. So the new asset, new liability represents the deposit, and they represent each other. Okay, I want you to remember that. You can't separate the value of the two. For us to win, we have to say the new asset, new liability represent the new money being deposited. Now the bank, they want to simply say only the bank liability, the demand deposit accounts the money, then they have to come back and say the legal tender is no longer the money. That doesn't make sense. Legal tender is still legal tender. I don't care if the bank holds it or you hold it. But the big thing to remember is the bank assets and liabilities increase. Okay, example number 2. If you withdraw $2,000 from the checking account, these are the bank bookkeeping entries. Now the DDA, that is demand deposit account. That was what we're talking about in example number 1. So if you withdraw $2,000, the bank no longer owes you $6,000. They only owe you $4,000 because they gave you $2,000. So we have to subtract $2,000 from the $6,000 that the bank owes us. So we have to put $2,000 in demand deposit account in the left-hand column. So since there's $6,000 in the liability account in example number 1, and there's $2,000 in the asset column in example number 2, the two net out, and there's only $4,000 left that the bank owes us because we took out $2,000. Now, record cash, legal tender, is a bank asset. The bank took $2,000 out of their vault and they gave it to you and I. So the bank no longer has that $2,000. They have to subtract $2,000 from the earlier $6,000 you and I gave to them. So there's only $4,000 left. So they had $6,000 in the asset column. The only way they can subtract that out is by putting $2,000 in the cash in the liability column. That's what that does, is that subtracts out $2,000 from the earlier $6,000, so there's only $4,000 left in the bank vault. So they still owe you $4,000, and they still have $4,000 of your money in the vault. That's all it really amounts to. Now, in example number 3, if you deposit a $5,000 check, this is it. Now, the RFRB, that means Reserve of the Federal Reserve Bank, and that means a check. That's the accounting terminology for a check when it comes to bookkeeping entries, okay? You can almost put in the word check there if you want. But the Federal Reserve Bank, they use RFRB, so I put it in the book. So, cash, if you have a check, you can get cash for it. So a check is just like cash in that respect. So they would go ahead and record the check just like they would cash if they deposit the check in a checking account. So they record the $5,000 check as a bank asset, and they offset it by a brand new bank liability called demand deposit account. So the bank owes that depositor $5,000 because the bank can get the $5,000 cash for that check. So in this case, it's like the depositor loaned the bank $5,000, and the proof is there's a liability saying the bank owes him the $5,000 for the amount deposited. So it's like you loaned the bank the $5,000, and the proof of that is they owe you the $5,000 because of the liability of $5,000. So what happens is you get a credit in your checking account by $5,000, and that means you go get cash. You can write a check on that $5,000 credit. Now you take a look at example number 4. Take a look at example number 4. If you're going to write a check out of your checking account for $1,500, the bank no longer owes you $1,500. I mean, since they're going to pay the $1,500, they have $1,500 of less money that they're going to owe you, right? So you had this checking account balance, and now you got to subtract that checking account balance is a bank liability, and you got to subtract out the $1,500 out of there because they paid it to you. So you have to put that $1,500 in demand deposit account under the asset column, or the debit column, same thing. And then you credit or put in the liability column, which is the same thing, $1,500 for the check, just like I did here in number 4. Now, you could almost replace the word check with the word cash. You could almost do that. In fact, we might even play a game here in just a few minutes. Okay, example number 6. Example number 6, we talk about the promissory note. This is where the banks claim they granted a loan. And in number 6 right here, they record the promissory note as a bank asset, and they created a demand deposit account, $40,000. Now, this is what the modern money mechanics claims happened right here. There's a new asset, there's a new liability. This demand deposit account, that could be in replace of that DDA, demand deposit account, you could put in the word checking account, you can put in the word savings account, you can put in the word certificate of deposit, you can put in a number of different things. But it all means the same thing. They still owe you $40,000 of legal tender because they recorded this promissory note as a loan from you to the bank, and they never paid 1 cent of any actual cash value for that promissory note as proven by the new bank liability. This new bank liability means they still owe you the legal tender. See, remember, if you deposited $40,000 of cash, all you do is replace the word cash with, get rid of the word promissory note and put in the word cash. If you deposited cash here, and they would have, in the demand deposit account for the $40,000 liability would remain the same. So if you deposited cash, $40,000, they'd owe you $40,000 in that demand deposit account. Now, if you deposited cash instead of a promissory note for $40,000, and they created a new demand deposit account, bank liability of $40,000, did they loan you anything according to this one transaction? And the answer is no, they did not loan you anything if you deposited cash. So if you just simply replace promissory note with cash, and you're talking to another bank auditor, you're saying, gee, if we did the same thing right here, just replace cash with a promissory note, or promissory note with the word cash, let's put in cash, and we have a new demand deposit account of $40,000, what would that mean? That would mean that you loaned the bank cash of $40,000, or you deposited $40,000 at the bank. And if that was the case, did the bank loan me anything? Yes or no? No, they did not loan you anything. Now, if I replace the word promissory note and just what I have right here in example number 6, and don't use cash, I just use the word promissory note, did the bank loan me 1 cent of any legal tender or other depositor's money according to bookkeeping entry example number 6? I want a yes or I want a no answer. And they would have to come back and say, no, they did not loan you 1 cent. Thank you. Now let's take a look at number 6 here. Let's say you deposited cash instead of a promissory note, and they gave you a demand deposit account of $40,000. Well, if you give the bank cash and they credit your checking account, which is the same thing as a demand deposit account, all you've done is exchange one type of currency, cash, with a different type of currency called checkbook money, a checking account balance. And they exchange that checking account balance from one checking account to another checking account, and the only way they can trade it from one checking account to another checking account is either by a check, a bank draft, a wire transfer, some mechanism like that. So all they did is, if you deposited cash for credit in a transaction account, all you did is exchange one type of currency for another type of currency. Instead of spending your cash, you're using a check. That's all. Well, right here, all they did is they had one type of currency called a promissory note because that has value. I mean, they used to trade cigarettes or gold, or they used to trade cows or chickens like money. Promissory note has value just like other things that have value. It could be traded just like money as long as people are willing to accept it. Did the bank accept this as having value to exchange for something else that has value? The answer is absolutely yes. So use one type of currency to exchange for another type of currency. There was no loan. There was simply an exchange of currency. So we talk about this exchange of currency. If you deposit cash, they exchange that type of currency for another type of currency called a demand deposit account that people accept because there's cash behind it. Always talk about they'll accept a check or a bank liability like money. It's not money. There's a difference. I got to go into this right now. Under the Uniform Commercial Code, they talk about a check is not money, but it acts like money, presuming there was money earlier deposited. Well, a demand deposit account is not money. It's a substitute for money, but it acts like money, presuming there's an asset behind it and attached to it with matching principles and the principles of accounting. So the asset is there to always pay that liability. People are not going to accept a bank liability can never be paid as money. There always has to be an asset behind it to make that payment. In this case, the promissory note for $40,000 is there to pay this liability of the bank. I hope that makes sense. All right, let's go on to number 7. The bank issues a check to the seller of the house. See, this is part of the loan. This is the loan now, what the banks call from the bank back to the borrower. What they do is earlier they had credited liability column, right-hand column, the demand deposit account for $40,000. Now they're writing a check, so the bank no longer owes them $40,000 in that checking account, so they have to debit $40,000 in the asset column, demand deposit account. So a credit and debit, or there was an liability in the asset under the demand deposit account, zeroes that out. And now they have a check, Federal Reserve Bank, RFRB, for $40,000, which is a liability. So the shortcut, if they really want to do a shortcut, they don't even have to use the DDA account. They can just simply deposit the promissory note as a bank asset and credit a check in the liability column. They could actually combine bookkeeping entry number 6 and bookkeeping entry number 7, put them together, and just eliminate the demand deposit account. I called up one of the big bankers where I used to live, and I said, I'm just a dumb CPA. I don't understand this. My clients are asking me banking questions. I said, maybe I can send some business to you if you could help me answer some questions. And the bank president said, sure. And I said, I know banks create money when they, grant loans and all that, and I just don't understand all this unless I kind of see it in accounting language. I said, what are the bookkeeping entries anyway when you grant loans? He said, real simple. He says, we record the promissory note as a bank asset, and we just credit a check. We just use that to fund a check, and we just use that to cut a check. And so we don't go through all those demand deposit accounts and all that, the Federal Reserve Bank. We just use the short version. The same result, just the short version. I said, okay. And And then I came back, and so I asked him more about what money is. I said, now, do we have to pay you back the exact same type of money the bank used to fund the check? And he says, yes. I said, and the bank asset is where they record the legal tender, isn't that right? And he says, right. I said, so then if we have to give you back the exact same type of currency, then we have to give you a second promissory note that would discharge the first one, isn't that right? He thought, and he says, I don't have time to talk to you, and he hung up the phone. So I've talked to confirmation after confirmation. What I'm saying here is just absolutely correct. All right, number 8. The seller of the house now receives the check, and he goes to deposit the check in the checking account, in his checking account. So now they record the check as an asset and the demand deposit account as a liability. So now from number 7 to number 8, the checks, the liability and asset on the checks cancel out. So now we have the net result between number 7, example number 6, number 7 and number 8 is what? There's a new asset called promissory note, and all it did is transferred from one demand deposit account to another demand deposit account. That's $40,000. But the bank still owes $40,000. But see, you don't go into a court and say, well, they still owe $40,000. No, really, what was deposited to create the $40,000? It was the promissory note. So they owe the borrower $40,000 because they made the borrower a depositor. They also claim that they were going to loan you $40,000, which they have not done. Since they altered the agreement and they made you the depositor, and they stamped the promissory note paid to the order of, they made you a depositor, and also the bank has a fiduciary responsibility toward you because you are the depositor. The Federal Reserve Bank says they loan depositors money, so you're the depositor, according to the bank bookkeeping entries. They exchanged the promissory note for credit in the borrower's transaction account. The borrower's possessive. Modern Money Mechanics, Chicago Federal Reserve Bank, page 6. So we're using their own publications to prove up exactly what we're saying. So they altered the agreement. They made you the depositor, so they owe you for the money that they deposited, which is the promissory note. They said they were going to loan you other people's money if you signed the promissory note. They didn't do that. So this bank liability means they still owe you $40,000 and you owe them $40,000. So if there's equal protection under the law, the bank has to pay their debt back to you, and you have to pay your debt back to them. Everybody has to pay each other's loan, and the loans cancel out. Isn't that nice? That's according to the bookkeeping entries. Example number 9. Now, let's say somebody, the deposit, the $40,000, now they want $5,000 of it. Well, then they have to subtract out $5,000 from the $40,000 in the demand deposit account, so there's only $35,000 left. So that means you have to put demand deposit account $5,000 in the asset column, which is the same thing as a debit column. And then they credit cash $5,000 in the right-hand column, which is the liability column, because they're taking $5,000 out of the cash vault. Remember, cash is recorded as an asset. And number 10, what do they do with this promissory note? They have to hurry up and get rid of it to cover up what they've done. So if somebody looks at the balance sheet like myself, if I see a bunch of promissory notes on the bank's balance sheet, a bunch of them, I'll know exactly what they did, and I'll scream bloody murder. So they got to make sure nobody sees that, so they have to credit the promissory note $40,000. That's that liability, the right-hand column. What happens? Earlier, it was under the asset column, now it's the liability column, so that makes it 0. And they replace it with $40,000 under the asset column called cash or government bonds. I walked into a bank one time. I said, where'd you get all these government bonds? He said, well, customers come in with cash. We don't get any interest on the cash. So we use the cash to go buy the government bonds so we get interest, and that's how we make our money. At the time I bought it, I believed it. Now I know they sell promissory notes and exchange it for the government bonds. See, as soon as they close that business day, they're on the phone selling those promissory notes that got signed that day. That's what they're doing. That's what I'm being told. All right. Now, example number 11, just like if the bank decides to buy government bonds, they just create a demand deposit account and just buy the government bonds. Isn't that nice? Just buy all the government bonds you feel like. Just create a liability and say you owe the money and never pay it. I mean, what a business. I mean, we all ought to become bankers maybe, I mean, if we just create money, just create wealth, no wonder why they get so rich. It's fantastic. All right, I want you to go back over these bookkeeping entries again. I want to try to explain it a little bit different way. All right, let's go back to the page where it has example number 1. If you're going to deposit $6,000 at a bank, it's like you loaned the bank the money. And the proof that you loaned the bank the money is the new bank liability. Liability means they owe you this. If I loaned you $100 and you would have a liability owing me that $100 back to Tom Schaff. It would be on your books. If I loaned you $100 on your books, you show you received the cash, and that'd be an asset, and you also show a liability saying that you owe Tom Schaff the $100 that I loaned to you. So that's what number 1 is. It's the same thing as if it's a bank or a manufacturing company, same thing if it's your personal financial statements. Okay, it doesn't make any difference if it's a bank or a restaurant or a shoe repair place or a car repair. It doesn't make any difference. Exactly the same. Some people say, well, banks do everything just the opposite. No, they don't. They do it like anyone else does it. They only tell you that to try to confuse you. And they got to use confusion to get your money for free. Okay, example number 2. They paid you back $2,000. So you got to decrease the $6,000 they owe you by $2,000, and that's that debit to demand deposit account in the asset column, because it's in the opposite column of the earlier $6,000. So you net the 2 columns together, they only owe you $4,000. And earlier, the cash was recorded as an asset. The left-hand column, so to subtract out $2,000, you got to put something in the right-hand column of $2,000. So the left-hand column showing cash is 6, owning cash is 6, and they gave up 2. It nets out, there's only 4 left. Example number 3. You loaned the bank $5,000 check. They can get cash for the check just like they can get cash for the promissory note. So you loaned the bank $5,000. Since the check has value and it's something that can be sold, you can see it, it's an asset. So you loaned it to them because you deposited it, so they have to create a bank liability saying they owe you the $5,000. The $5,000 in the liability column here is a scorecard, and it has your name on it. It says, we owe Jim $5,000. Example number 4. You want your loan paid back in the amount of $1,500. So they owe you $1,500 less money. So they got to subtract out $1,500 from that liability. So they have to put that $1,500 they subtract out in the asset column under demand deposit account. So you take $5,000 minus $1,500, and you end up with what? $3,500 they still owe you. And they gave you back $1,500 of cash or cash equivalent, so they have to credit the liability column, $1,500, which subtracts out the earlier $5,000 that was under the check or RFRB. So you loaned them, you got part of your loan back. So you got to record getting part of your loan back. Now, example number 6 is no different than loaning the bank cash, or loaning the bank a check, or loaning the bank a promissory note. There's no difference. They just don't want you to know what they've done. That's all. They try to trick you. So this number 6 is, since they have a liability of $40,000 under demand deposit account, that means you loaned them the $40,000 promissory note. That's all. That's all number 6 means. They recorded this as a loan from you to them. Now take a look under the word loan under Black's Law Dictionary, and this is all the evidence you want and all the evidence you need under Black's Law Dictionary under the word loan to prove up there is an agreement for you to loan them the promissory note, or they stole it, one or the other. Take a look under Black's Law Dictionary, the word loan. It talks about an express or implied. So if it was not a loan to the bank, it has to be a theft. That's all it is. Okay? You never agreed. See, what does that promissory note represent? It represents your agreement to repay them $40,000, your future labor. So they're saying that future labor has value, and they're going to record it as value on their bank's books. And for that, they're also recording they owe you $40,000. Now, if you loan them the value of your future labor, and that's all that bookkeeping entry means, what's the difference if they record the promissory note as an asset here, or if they recorded cash and they receive, cash from you? If they receive cash from you, then they would claim that this demand deposit account that they owe you $40,000. But if they record this promissory note as $40,000, they can be exchanged for cash. Then they try to hide it and say they don't really owe you the $40,000 under that demand deposit account. You can't change bookkeeping entries like that. It's either it has to be consistent one way or the other. If you deposit cash of $40,000 and you withdraw the money, then it has to be a loan from the bank back to you if it's a loan from the bank back to you if you deposit the promissory note. Or if you deposit cash and that you get the money back as a return to capital, then if you deposit the promissory note, you get the money back as a return to your capital, not as a loan from the bank back to you. It has to remain consistent. And they're trying to mix all this up. So number 6 here proves that they record the promissory note as a loan from you to the bank. They loaned nothing to you if they record the promissory note as a loan from you to the bank. Are you following what I'm trying to say? I hope you are. So read these little paragraphs that I have after this as you listen to this cassette tape. It's really important you understand these bookkeeping entries. Okay, now number 7 and number 8, all it is right here is transferring from one demand deposit account what the bank owes to another demand deposit account. That's all it is. Okay, now I want you to do something here. You can write in your book or whatever you want, but on number 6, I'm going to show you the trick that they're going to try and use with you. And this is part of the short stories with the CPAs, okay? On example number 6, where it says promissory note, they debit it for $40,000 under the asset column, and then demand deposit account, the credit liability. Cross out the word DDA, demand deposit account, and just write in the word check. I'm just writing the word cash. And in example number 7, I want you to cross that out. And in example number 8, all you have to do is cross out the word check or RFRB and write in the word cash. Okay? Now, if you did just that, so you only have example number 6 and number 7. So you have a credit to cash and a debit to cash. They're going to try and claim, but we loaned other depositors cash to you for that promissory note, and that's the lie. But the net result between number 6 and number 8, when you do what I ask you to do by crossing those out and putting it in cash, there's a new asset and new liability. Now, if they loaned other depositors cash, what would they have had to have done? If they loan other depositors cash to you, they would have had to do the same thing as in example number 7, that same bookkeeping entry in example number 7. But where the word cash is, you can just replace the word cash. Where the word check is, you can replace the word cash in example number 7. So it's like they'd be crediting cash for $40,000 instead of a check. It doesn't make any difference if it's check or cash, but we're talking about cash. So they want to come back and they want to say, well, we loan other depositors money. Look, if they loan other depositors money, they're going to have to debit the demand deposit account as an asset so that the people that have savings accounts and CDs can no longer spend their money. And they'd have to credit cash. And they could not, under any circumstance, record the promissory note as a bank asset if they were loaning other depositors money. The only way they could do that, have a promissory note as a bank asset, is if they sold cash for a promissory note. Just like they could sell cash for government bonds. That'd be the only exception. But if the promissory note was used to fund a check, they have a real problem. So in this process, if they're recording a new asset called promissory note and they end up with the net result of a new asset, which they're doing, that means they did not loan other depositors money. But that's how they're going to try and trick you. They're going to try and lie to you. So what you do is you simply say, well, I'll tell you what, you record the promissory note as an asset and you credit cash, right? And they're going to say yes. And I said, what does the seller do with that cash? Well, they usually deposit it at the bank. I said, if that's the case, they debit the cash and they credit a demand deposit account. What's the net result? Well, they credit cash, debit cash, the cash gets canceled out. What's the net result? New asset, promissory note, and new bank liability called a new demand deposit account. Uh-oh, they got a problem now. So that's how I want you to view this, and that's how I want you to look at this. Now look, the key is, if you know and understand the bank bookkeeping entries, and if they know that you know the answer to this, they're going to have one tough time arguing with you. And what I've seen is if you get on that witness stand, or they do, rather, and they think you just, filed some lawsuit and you don't understand it, they will turn and attack you viciously because they know they can destroy you. But if you file a lawsuit, and I've seen, I'm not saying do it, I'm not suggesting you do it, but I'm simply saying my observation is in the past that people have filed lawsuits and understand the bookkeeping entries and understand how to ask the questions, can rip the gut out of them if they can keep this in court in front of a jury and not have it thrown out. And that's where you need your expert witness, you need your attorney. But those who do not understand the bookkeeping entries, man, the banks will turn and attack you very, very viciously, and you better know your stuff. So I've taught you this, so now you can speak the language to another CPA. And that's why I taught you the way I did. All right, now we're going to have to go on to the next cassette tape in here just in a moment. Now I'm trying to teach you the best I can. And I want to go to your area, I want to put on seminars, and I want to have an advanced seminar for those who purchased this course. And those are the people I really want to talk to. One seminar for the people right off the street that don't understand it, and the second seminar for the more sophisticated people that understand this. So I'd like to come to your area and put on these seminars. I think it'd be really, really beneficial for everyone, okay? At this time, please, let's go on to the next cassette tape.